Welcome to the Deep Dive. Today we're unpacking a recent earnings call transcript you shared with us, BLND Labs, that's ticker BLND, for their first quarter of 2025. They're a software provider, mostly for banks and lenders in the mortgage and consumer space. Our goal here is to really sift through this call, pull out the key insights, maybe find some surprises, and understand the story BLND is telling you about how they're doing and where they're headed.
Absolutely. And, this transcript really lays out a story. It's a story of a company making a big strategic change, becoming software first in a market that's still, let's say, tricky.
Right. Not exactly smooth sailing out there yet.
Not yet. But the key thing is they're arguing this pivot is actually starting to pay off. We're seeing it in the numbers, the sales wins.
Okay, so give us the high-level view. What's the main narrative from this call?
The core message is simplification works. They're doubling down on being a software company, shedding other parts. And this focus, plus some big shifts in the industry, like that Rocket Mr. Cooper deal, is building real momentum.
Momentum despite the market.
Exactly. They hit some important milestones. Third quarter in a row of non-GAAP operating profit. And this was a big one, record positive free cash flow in Q1. So they feel like, okay, we've stabilized, we're profitable, now we can actually invest in growing the business again.
That's a significant shift in tone, isn't it? From tightening the belt to looking at growth investments.
It really is. And that simplification piece is crucial. The biggest move there is they're trying to sell their Title 365 business. They're in an exclusive process right now.
Okay, Title 365. Explain why selling that fits the software first strategy. It sounds like a big chunk of business.
It is, but it's also capital intensive. It's not purely software. So getting out of the, let's call it the traditional title agency side, is the final step, really, in making BLND a true software platform. It aligns everything.
But selling it means less revenue, right? How does that work out better for them?
Yeah, that's the interesting part. They expect lower reported revenue from that activity, but potentially higher absolute profit dollars.
Lower revenue, higher profit?
By structuring it differently. The idea is to keep a software revenue stream linked to title, sort of like how they partner for homeowners insurance or income checks now. They provide the tech layer, the integration, but they don't run the whole capital-heavy operation themselves.
Okay. So they get a slice of the pie through software, which has much better margins, and they ditch the operational headache and capital needs.
Exactly. It improves their overall gross margin, makes them more capital efficient, and it pushes forward their vision for, a smoother, tech-driven title process embedded right in their platform.
And they introduced a new metric to track this kind of profitability focus.
They did. Contribution profit per funded loan. It's meant to show how much actual profit they make on each loan transaction, considering these higher margin partnership models. It's like their internal compass now for deciding which products and deals make the most sense financially. Very focused on profitable growth.
Got it. Okay, let's shift to those industry dynamics. They mentioned the Rocket Mr. Cooper deal as a catalyst. What was their take?
They see it as a potential game changer. Kind of like when Rocket first launched that push-button get mortgage idea years ago. It resets expectations.
Oh.
Well, BLND argues this huge alliance validates the very vision they've been pushing, a unified, digital, customer-focused mortgage experience. When giants like that make a move, it lights a fire under everyone else.
And are they actually seeing that fire? Are people calling them?
Apparently, yes. They said they saw a noticeable jump in calls from customers and prospects basically saying, okay, we need to react to this. We need better digital tools. They mentioned they now work with 10 of the top 20 mortgage servicers. And interestingly, Mr. Cooper itself, they're a longtime BLND customer using their latest tech.
So it's less about if institutions should go digital and more about how, and maybe using platforms like BLND to get there faster.
That seems to be BLND's interpretation. The debate isn't just build versus buy anymore. It's about using the right platform pieces, integrating them smartly with your own systems to create something better. They want BLND to be a key piece of that puzzle.
All right, so strategic changes, industry tailwinds. How did this translate into Q1 sales? Did the momentum show up?
It seems like it did. They signed 11 new or expanded deals in Q1. That doesn't sound huge maybe, but it's nearly 3 times what they did in Q1 last year.
Yeah.
And Q1 is usually the slow quarter for this industry.
3 times is significant. And did that pace continue after Q1 ended?
They said yes. About a month into Q2, they'd already closed another 10 deals. So the momentum seems real and ongoing.
What kind of deals were these? Big names. different products.
A good mix, it sounds like. They specifically called out signing a top 5 mortgage servicer and also a top 10 mortgage originator. And importantly, these weren't just for one product. Deals often span mortgage, home equity, and their closing solutions.
And how quickly do these deals turn into actual usage and revenue?
Typically takes a couple of quarters, they said, for deployment.
Yeah.
Often, a big customer starts with the main mortgage solution, which might actually lower the average value per loan initially.
Wait, lowered it? Why?
Because the core mortgage piece might have a lower initial economic value than some add-ons. But then, they said, these customers quickly layer on things like Blend Close or the new Rapid products, which bring that value per loan back up, and then some.
Okay, that makes sense. So the overall argument is strategy plus industry shifts equals renewed investment willingness from lenders.
That's the core of their narrative right now. They believe the market, or at least parts of it, is stabilizing enough that institutions are ready to pull the trigger on major tech upgrades again, and Blend is capturing that demand.
And speaking of major, they announced a huge deal, right? Their biggest ever.
Yeah, signed early in Q2. A $50 million renewal and expansion with a top financial institution. It's a multi-product deal, and they're positioning it as proof their platform can scale massively and as a template for how other big players can grow with them.
They also seem pretty excited about their newer products, the Rapid Home Lending Suite.
Definitely. That suite targets refinance and home equity, and the timing seems good. Homeowners have a ton of equity. Right now, they threw out a number, like $315,000 on average. Lenders want to tap into that.
Makes sense. And refi is always waiting in the wings for rates to drop.
Exactly. So these Rapid products are built for that. They promise hyper-personalized, real-time approvals to capture borrowers when they're actually interested, not days later.
Did they have any proof points on whether it actually works?
They mentioned early tests showed conversion lifts over 50%. In an industry where getting a loan costs something like $11,000 on average to originate, boosting conversion by 50% is massive.
Huge. And what does it mean for Blend's own economics?
Also positive. They said customers using Rapid products are paying about 1.9 times more in economic value per funded loan, or EVPL, compared to baseline, based on the deals signed so far. So it's better for the customer and much better margin for Blend. A win-win.
So better conversions, better economics. That sounds like the kind of product they want to push.
Absolutely. It fits the whole strategy. Higher value, better margins, solving real customer pain points like conversion and speed.
Was this momentum just in mortgage, or did they see action in consumer banking too?
No, it was broader. They signed multiple deals for deposits and consumer lending too. One standout was a top 25 credit union, over 400,000 members, signing up for basically the entire Blend suite deposits, cards, personal loans, home lending, a big multi-year deal.
Wow, the whole suite. That's a strong endorsement.
It is. It really speaks to the appeal of having that single end-to-end platform for these larger institutions.
And they just rounded out that consumer suite, didn't they? With business accounts.
Yes, they launched business deposit account opening. Apparently customers were asking for it. You know, your retail customer is often also a small business owner. They want one seamless experience.
Is opening a business account much different from a personal one?
Oh yeah, more complex. You got different regulations, things like know your business or KYB checks, different entity types, but they built it on the same core Blend platform. So now an institution can use Blend for consumers and small businesses across lending and deposits. One unified system.
Okay, let's get into the Q1 numbers themselves. Focusing on the ongoing platform business, what did the revenue look like?
Platform revenue was $26.8 million. That beat their guidance midpoint and was up 12% from last year. Importantly, that's the third quarter in a row of year-over-year growth for the platform.
And how did that break down between mortgage and consumer?
Mortgage Suite brought in $14.6 million. The Consumer Banking Suite was $9.6 million, but that part grew really fast, 45% year over year. Professional Services added another $2.5 million.
And profitability. Margins.
Looked better. Platform non-GAAP gross profit hit $19.5 million. That's a 73% gross margin, up nicely from 68% last year. Shows that shift to higher margin software and partnerships paying off.
And operating expenses, were they still keeping costs down?
Definitely. OPEX was $18.5 million, which is actually down $9 million from Q1 last year. All those efficiency efforts are visible. And that led to $1 million in non-GAAP operating income, top end of their guidance, about a 4% margin.
So profitable even before the market fully recovers. That seems key to their operating leverage argument.
That's exactly their point. They've structured the cost so that when mortgage volumes do eventually pick up, a lot of that extra revenue should flow straight to the bottom line. Significant leverage potential there.
What about the balance sheet? Cash position?
Pretty solid. Ended Q1 with about $110 million in cash and equivalents. They also bought back $3.1 million of their stock, saying they think it's undervalued. Still have authorization for about $22 million more in buybacks.
And you mentioned that record free cash flow number earlier.
Yes, $15.5 million in positive free cash flow for Q1, a 58% margin on revenue for the quarter, which is huge. They did say a chunk of that was collecting cash from a big deal signed late last year, but still it shows they can convert these wins into actual cash.
They also hit a record on RPO remaining performance obligations. Remind us what that is.
RPO is basically contracted future revenue. Commitments from customers like minimum platform fees. It hit $158.1 million in Q1. That's way ahead of the $150 million target they had for the entire year of 2025.
Wow, ahead of the full year target already in Q1. What drove that?
Just the overall deal momentum, they said. The number of wins, the quality of those wins, and getting customers to commit to minimums and platform fees as part of those deals. They expect about half of that RPO to turn into revenue over the next 12 months.
Okay, let's connect back to that economic value per funded loan, EVPL. It was $93 in Q1, slightly below guide. How does this relate to the new contribution profit metric again? This seems like a key shift.
It is, and it's a bit nuanced. They shared some numbers to illustrate. Think about their add-on software and partnerships. Back in Q3 2024, those contributed $17 to EVPL, but only $6 to contribution profit, like a 35% margin. Now, in Q1 2025, those same types of services contributed $15 to EVPL, slightly less on the surface, but generated $10 in contribution profit. That's a 67% margin.
I see. So the actual profitability per loan from these strategic high margin areas is going up significantly, even if the headline EVPL number bounces around a bit.
Precisely. The EVPL number can dip temporarily, especially when a big client first comes on board with just the basic mortgage piece. But the underlying contribution profit per loan, driven by these partnership models and value-add software, is improving. That's the metric they are focused on internally.
Did they guide for EVPL in Q2?
They did, slightly lower at 88 days. They suggested this might be the bottom as the new rapid products and other higher value things start kicking in more during the second half. The takeaway is don't just watch EVPL, watch the underlying profitability trend.
Makes sense. So what do they guide for Q2 and the full year overall?
For Q2, platform revenue guidance is $30.5 million to $32.5 million. Midpoint implies about 10% year-over-year growth. And non-GAAP operating income is expected to jump up quite a bit to between $3.5 million and $5 million.
That's a nice step up in profitability from Q1.
It is. For the full year, they kept their operating expense guide the same, $85 to $90 million for platform non-GAAP OPEX. And they reiterated that goal of hitting the Rule of 40 revenue growth plus operating margin by the end of 2025, driving that operating leverage.
Okay, earnings calls always have that Q&A section where you get some extra flavor. What stood out from the Q&A part of this transcript?
A few interesting things. One was the explicit statement about investing for growth. Now that they feel they've simplified, gotten profitable, got cash flow positive, they've earned the right, as they put it, to invest.
And where are those investment dollars going?
Primarily 3 areas within that existing OPEX guide. Number 1, the rapid products, building those out further. Number 2, AI, especially for things like document processing, compliance checks, stuff that's really data heavy in banking. And number 3, go to market, more sales capacity, better coverage.
AI in banking seems like a no-brainer just given the processes involved.
Totally. They said AI is powerful because banking is about moving bits, not atoms, lots of potential. They're using it internally too, which helps them figure out customer solutions.
Anything else on product direction from the Q&A?
They confirmed the business account opening product came from customers asking for it. They talked about potential future areas like commercial lending or going international, but emphasized those are much lower priority right now than nailing their current core products, the Rapid Suite, the Consumer Suite. The platform could do it, but focus is key.
What about capital deployment, especially if that title sale happens?
Still focused on ROI, reinvesting proceeds and free cash flow back into those growth areas, AI for product, and go-to-market for sales, partnerships, and implementation. disciplined approach.
And they doubled down on the partnership philosophy.
Yes, explaining why they partner instead of building everything. It lets Blend focus on being best in class at its core things, and partners want to integrate with Blend because Blend has this wide range of customers, from huge banks to credit unions. It creates value for everyone efficiently.
Did they add any more color on the Rocket Mr. Cooper impact?
Just that they see it affecting everyone. Banks, credit unions, mortgage banks of all sizes are rethinking strategy. And they feel servicers, in particular, are well-positioned for potential refi boom and are gaining share. They describe the market as spring-loaded, just waiting for rates.
What about that contribution profit metric? Did they give more detail on the actual numbers?
Not specific aggregate numbers for the core products yet. They said it's a guiding light internally, and margins on partnerships are extremely high. But it sounds like we'll hear more about this metric going forward as they track progress.
And RPO, did they clarify if that $50 big deal was in Q1 RPO?
No, they confirmed that's a Q2 RPO addition. The Q1 RPO growth was driven by all the other deals they signed and the platform minimum commitments within them.
Okay, final point from Q&A. What are their absolute top priorities for 2025?
They were very clear. Priority number 1, make sure existing customers love the current products. Huge emphasis on customer happiness and adoption. They mentioned a customer advisory board.
Makes sense. Keep the base happy.
Priority 2, help those happy customers adopt the valuable add-ons. Blend close, rapid products, things that drive more value for the customer and better economics for Blend. Priority 3, only after nailing 1 and 2, is to talk about cross-selling other suites consumer to mortgage clients or vice versa. Earn the right to expand.
Seems like a logical progression. Any comments on scaling their sales efforts?
They acknowledge the challenge of reaching beyond the biggest institutions. They're exploring different models for that smaller end of the market, maybe partnerships, different internal teams. But overall, they seem pleased with the sales team's performance and focus, especially on existing customers.
All right, so let's wrap this up. We've dug through the transcript. What does this Blend Labs earnings call really mean for you, the listener?
Well, it paints a picture of a company that seems to be successfully navigating a pretty major strategic shift, getting lean, focusing purely on software, potentially selling off a big legacy piece, and critically, they're showing evidence it's working. Consistent profitability, record cash flow, accelerating sales wins, even with market headwinds.
And they're positioning themselves for what comes next.
Exactly. Investing in areas like the rapid products for home equity and refi, embedding AI, all while benefiting from big industry moves like that Rocket Mr. Cooper deal acting as a catalyst. It's a story of execution meeting opportunity, perhaps.
So for anyone watching fintech, or even just interacting with banks online, what's the takeaway?
It highlights this relentless push towards unified, personalized digital experiences in finance. Big M&A deals are forcing the issue. And the way Blend is building its platform, focusing on core software and integrating specialized partners, shows how institutions are assembling their tech stacks now. It ultimately shapes the tools and processes you encounter when you apply for a loan or open an account.
And remember, these insights came directly from the company's own narrative during their earnings call.
So the final thought to leave you with, as more banks and lenders adopt these kinds of platform-based, software-centric approaches like the one Blend is championing, does it fundamentally alter the competitive advantage of traditional players? Or is it simply giving them the modern weapons they need to fight back effectively in a digital-first world? Something to ponder as these financial technology trends continue to play out.